Bienvenidos a una nueva edición de Trading, Risk and Beyond. En esta ocasión tenemos un programa especial donde contamos con el privilegio de la visita de Robert Engle, Premio Nobel de Economía 2003, a México para participar en la Risk Management and Trading Conference. Pudimos conversar con él sobre su área de expertise, volatilidad y en particular los volatility clusters, que fueron lo que le ganó el Premio Nobel. La entrevista tuvo lugar el día 23 de junio, tan solo unos minutos después de que los medios de comunicación nos anunciaban a un mundo asombrado que los británicos habían decidido dejar la Unión Europea después de más de 40 años. ¿Qué implicará esto para el futuro de los mercados, para la volatilidad de las monedas? ¿Deberíamos factorizar el elemento Trump en nuestros modelos de volatilidad en los siguientes meses? De todo esto y más conversamos con Robert Engle. Acompáñeme a escuchar sus interesantes opiniones sobre estos temas. What can we expect in terms of volatility and the economy in general in the next months?
Well, I saw in the paper this morning that people were lined up at their ATMs in Britain to get euros and dollars out in advance of this election. So this is their way of hedging what I think people are worried about. They're worried that if when this occurs, that the pound is going to fall dramatically, and they don't want their standard of living to fall. So they're hedging by using the foreign exchange market. And I think that's that's the first thing I think we would expect to see. I think we will expect to see a collapse in the pound and probably in the UK stock market. But I think over a longer period of time, there will be a whole lot of changes because Britain will no longer be able to trade so freely with the rest of the European market. Firms that are in Britain, because it gives them complete unfettered access to the European market, will find that they are not as profitable as they were before, and so they may reduce their employment in those sectors and build it up in Paris or Amsterdam. Or Frankfurt. I think that there is a very reasonable chance that the British economy will go into a recession, and volatility typically is higher during recession times than other times. So I think that the Brexit vote is likely to produce a long-lasting period of volatility clustering and higher volatility for British assets.
Volatility has been used or has been blamed for many things. Since the 80s and 90s, we hear the word volatility when trying to justify crossing the lines, circumventing regulation, taking unnecessary risks or unnecessary exposure, even doing rogue trading. How are we right now in terms of dealing with volatility in financial institutions?
Well, I think the first thing people realize when they think about volatility is that it's a risk. It's a risk for people who invest in these assets, because what volatility really is, it means that the prices of these assets move in ways that you didn't foresee. And the question of volatility is, how big are those effects? And the background for your question is that we wonder, where does volatility really come from? Why do asset prices not stay where they're supposed to be? Why do they change? And I think the answer is that there are good reasons for volatility. There are good economic reasons for volatility. When a stock price goes up, often it's because there's good news about this company. And we think, therefore, that volatility is actually the response to real information. and it's the response often to just a little part of that information. People respond in a way that they predict what's going to ultimately happen, and so sometimes those predictions are wrong, and then the prices come back down again, and we see volatility as information reaches the market. So I think that the best way to think about volatility is it's high when there's a lot of uncertainty about where the economy or where these particular asset prices are going to go. And as that information is revealed, we see the volatility either going up or going down, depending on the information.
So volatility doesn't mean that the efficient markets hypothesis is not working, but it's a confirmation of the efficient markets.
It's a confirmation of the efficient markets. Okay. I sometimes ask my class, can you imagine finance without volatility? It means that you wouldn't have to pick which stocks to buy because they'd all have a constant price. You wouldn't have to decide which countries to invest in, which companies were going to have big innovations and have increased market share. It's all going to be constant. There is no risk, there's no return. Finance wouldn't work at all.
A colleague of yours, another Nobel Prize winner in economics, Mr. Merton, once told me that without risk, finance would be net present value and you could be done in one afternoon. But now let's talk about risk and how we model risk. Some thinkers say that it's surprising how many risks the financial institutions fail to see, and that's how or why we have crisis. What is the status right now of model risk?
Well, I think the process of trying to estimate risk is continual. There is no end to this because risk is continually changing and it's always there. However, the important thing that we of course recognize is, and this is what's in Merton's quote, is that if you think that there is a reward for taking risk, then you have to know what the risks are. You don't get reward for just being alive, you get the reward for taking a risk, and a risk that actually is foreseen is necessary to get a risk premium. So how good are we at measuring these risks? And do we really see them coming? And I think the answer to that is a little complex because there are many different kinds of risks, as you point out. They respond to many economic outcomes, as we've described, but often they come in clusters. One of the stylish facts of financial markets is that you see clusters of high volatility, clusters of stock or bond returns that move up and down in a short period of time. And consequently, we can do a pretty good job of predicting risks, at least in the short horizon. In fact, the Volatility Institute now publishes every day on the internet estimates of volatility for thousands of assets. But we started this at the beginning of the financial crisis. So one of the things we did was to go back and look and see how well those forecasts picked up what actually happened during the financial crisis, which was a totally unique piece of experience that we hadn't really had before. And the models were estimated on periods which didn't have this. And the answer was, it did a very good job of forecasting the risks and the value at risk that you could expect. But it only forecasted in the near horizon. Mm-hmm. It was great at forecasting the risk one day ahead. Mm-hmm. And that's the tool that we use for an awful lot of risk management, forecasting short-run risk. And I think the frontier of getting better risk estimates is to try to figure out how do we estimate risk further ahead than that. If you want to know whether there's going to be a financial crisis, mm-hmm. you don't want to know the day before it starts. You want to know 6 months before it starts. And that is a task that's very hard to do. And that's the frontier, I think.
Okay, you just mentioned a very interesting concept. Volatility comes in clusters. We have been living through some volatility recently, in the recent weeks and months in Mexico and in the world. A lot of flight to quality in the FX market that has hit hard Mexican peso. How long do you expect this flight to quality, this volatility, to continue in the next weeks, months?
Well, that's, of course, one of the things that the statistical models estimate. How long do these volatility clusters last? Because if you forecast volatility as remaining high while you're in the volatility cluster, then once it's over, you've got to forecast the volatility to come back down again. Mm-hmm. So it turns out, of course, that there are lots of different examples. And I mean, often volatility clusters last a few weeks, maybe less, but sometimes you'll have, like during the financial crisis, you could think about that as a 2 or 3 year cluster of high volatility. So there are some longer clusters and some shorter ones, and statistically it's you have a hard time separating those ahead of time.
So the only thing certain for now is no certainty of what's going to happen.
The certainty, I think, is that if volatility is high today, it will eventually come back down again.
But we don't know when.
We don't know when.
Okay. Could we have a volatility cluster associated with the American elections, for example?
Absolutely. I don't think we've begun to see how volatile how much that's going to scare the financial markets, but I think there is some evidence that it's going to.
Do you think that we could factor in some Trump effect into the volatility models?
People are already talking about that.
Okay.
The volatility models that I focus on are typically using data up till the current moment, but you can be even smarter than that. You can use future events like elections coming up to try to improve the models, and probably there would be a Trump factor that would be important in that.
So overall, are models still working, or can we expect in the next months or years renewed models, revised models?
I think the models are working, and I think that, just because there is a risk doesn't mean that it's going to happen. It just means it could happen. And just because the volatility is low doesn't mean there couldn't be a big spike. Mm-hmm. It's just unlikely, because at each point in time, all we can hope for is finding the probability of different amount of events. And when that probability distribution gets spread out, it means there's more probability of extremes, and those extremes could be on the upside or the downside.
Yeah, just what we needed, a little bit more volatility. Mr. Engle, given all this volatility challenge that people in the finance sector have to face day by day, and that they're going to have to live with it for the next foreseeable future, how important is education? How important is training in financial fields?
I think it's very important. I mean, we're learning all the time about new ways to measure and forecast and hedge volatility, and new trading strategies that can reduce your volatility. There certainly is a whole lot of interest in low volatility funds. There's a lot of interest in low beta funds. There's a lot of interest in risk neutral funds. And some of these are fads that will go away, mm-hmm. and markets will adapt to them. But some of these are trading strategies that will continue to add value for people in the long run.
Given the fact that you are obviously familiar with a lot of top level events in finance all over the world.
Well, I think this is a very exciting meeting. I think you've brought together a lot of really top people talking about important questions that really affect everyday profit and loss of corporations and brokerages and pension funds and all sorts of financial institutions. So I think, the kind of training that's being offered here is very important.
Audio Jungle.